Brad Williams, Frugal Finance, hedging the asset and liability portfolios individually. Armed with the duration analysis of its balance sheet, FSF can use the swap markets to protect itself against unanticipated changes in interest rates. We first want to look at how the asset and liability portfolios can be protected against volatile interest rates individually. In the next section, we show how to synthesize the entire analysis into an integrated solution. For both the asset and liability portion, we use the swap of the preceding section as a hedging instrument. The swap had a 7-year tenure, semi-annual payments, and an SFR of 7%. As discussed in the preceding section and computed in Table 22.3, the duration of the fixed side of the swap is 5.6 years. With semi-annual payments, the duration floating side is 1/2. So the duration of the received fixed position in the swap is 5.15, and the duration of the pay fixed position in the swap is just a negative 5.15. In general, the solution for hedging an existing asset or portfolio X with the hedging vehicle H, the duration approach is given D times M of V times plus D of H times M of V equals 0, where D of X is the duration of the position to be hedged, D of H is the duration of the hedging instrument, M of V is the market value of the position to be hedged, and M of V H is the market value or notional principal of the hedging vehicle. The market value of a swap in the sense of equation 22.2 equals the notional principal. To completely immunize a position from changes in value due to changes in interest rates, the desired duration should be 0. Given the existing position and the choice of hedging instruments, the problem is to find the amount of the hedging instrument, which is M of V, that satisfies D of X times M of V plus D of H times M of V equals 0. Therefore, FSF can protect the market value of the asset and liability sides of the balance sheet by combining each with the interest rate swap of the preceding section. For the asset portfolio, the duration is 3.9 years, so we need a pay fixed swap with its duration of 25.15. We apply D of X times M of V plus D of H times M of V equals 0 to find the correct notional principal for the swap, M of V times 8, and have the following: D of H 3.92 times 155 minus 5.15 equals 0 equals 392 times 155, 467, 133. Divide this by 5.15 equals 118,365. M of V of H for the asset equals 118.3 million in a pay fixed swap. Therefore, we can hedge the asset side of the FSF balance sheet by entering a pay fixed swap with the notional principal here of 118.3 million. Similarly, we can use the same swap to hedge the liability side of the balance sheet. The total liabilities are 139.1 million. Because these are liabilities, FSS has a short position in these instruments. Therefore, considering the liabilities on their own, FSF will need a receive fixed swap to complete the hedge. Again, applying D times M of V plus D times M of V. To the liabilities, we have the following: 1.705 times negative 130, 725 plus 5.15 times MV, 1.75 negative 139, 111, 725 divided by 515 minus 46 million. M of V for liabilities is 46 million in a receive fixed swap. Simple number crunching, understanding the variables, and understanding what we're trying to do is the goal. Pretty straightforward, but it may be new, and the idea of introducing something like this to your boss might be a little scary, but you just have to work at it. Brad Williams, Frugal Finance. Thanks for watching.